I'm Taylor Riggs in San Francisco in for Emily Chang, and this is Bloomberg Technology. Coming up in the next hour, Apple's shine. The company keeps hitting records, plus a new milestone in China. We'll have details. Plus, chew on this. The food delivery business is getting very crowded, and Grubhub may be looking to consolidate. We'll explain. And sales floor in the sky. It is no news that Microsoft competes with Amazon in the cloud business, but a new target seems to be its retail customers. But first, to our top story, and that is last year, Apple CEO Tim Cook stunned investors when the company readjusted its forecast due to struggles in China. Well, what a difference a year makes. Official government data shows that the Apple smartphone shipments in China grew almost 19% year over year in December. That marked a big jump from previous months, and it's particularly remarkable when shipments of phones of all brands were down nearly 14% in the same period in China. For more, I want to bring in Bloomberg Technology's Alistair Barr. Are you surprised by the amount of bullishness that we seem to have on Apple and the iPhone shipments in China?
Certainly in China, that number is a surprise. So that there's a broad push in China to focus on Huawei and have consumers buy Huawei phones instead of iPhones, and that was a concern for a lot of last year. Some of the trade tension has come down in recent months, so maybe that has something to do with it. But I think more to the point is that a device like the iPhone 11 is a little bit cheaper. The battery life is very, very long, and the photos that you can take are a lot better than the previous version. So that when you put all those things together and then you combine it with really a large backlog of older iPhones like the iPhone 6 and the iPhone 6s, which were really, really huge hits, those devices are 3, 4, 5 years old even. So there comes a point where just millions and millions of people are going to upgrade. Are they going to upgrade to something else? Probably not. They're going to upgrade to a new iPhone.
And I think one of the other things that surprised us was the fact that the iPhone 5G phones aren't out yet. What then was sort of driving the big push that we saw in December?
Yeah, I think partly it is this upgrade wave. So even let's say even if they didn't produce the iPhone 11 and just had the same new phone from last year, if you have an iPhone 6s which is 4 years old and the battery is running down, you really have to upgrade at some point. And I think, jumping to an Android phone nowadays is becoming a bigger and bigger step for people, because a lot of your digital life is run through these devices now, and there are other ways that Apple hooks people into the ecosystem. So really giving that up and going somewhere else is really a huge step, and people aren't willing to do that.
I want to touch on a company that you mentioned earlier, which is Huawei. Frankly, I'm a little bit surprised that we haven't seen more nationalism in China about Huawei and then pushing away Apple.
Yeah, I think that's very true. I think part of it is this ecosystem issue. So if you already have a Huawei phone, you're used to the Android operating system, and you probably will stick to that. So I think Apple now, the challenge really is kind of a lot lower than 2 years ago. Even 2 years ago, investors were expecting the company to keep growing iPhone sales and unit sales. And then after that real shock last year, that really reset the bar. And now if Apple gets like 5% growth a year in iPhone unit sales going off into the next few years, investors will be completely over the moon, because there are other things that are coming that will add to the growth.
You mentioned the ecosystem. As we know, they really try to draw us in the services business and the wearables business. Where else do you see Apple sort of trying to tie us in when it comes to keeping us in that ecosystem?
Well, so we were discussing earlier actually the idea that there really hasn't been a lot of bad news about Apple lately, and when you look at the stock chart, it's just incredible. The last couple of weeks just keeps going up and up. And another one of the stats that was driving that was App Store performance over the holiday week between Christmas and New Year. And Apple always puts out a number, but this year it was pretty solid. So it was this is App Store spending by consumers, and then that was up 16% year over year, and that implies that people are still, even if you haven't bought a new iPhone, you might buy a new app with a subscription, and Apple gets 30% of that type of thing.
I want to come and quickly look at a chart here that I'm showing inside my terminal, which it looks like the shares appear to be fully valued. I mean, the Apple share price is at a 309 today. Even the median price target on the street is around a 275 or so. What is this sort of bullish consensus that you get from the street of what else could drive this stock higher, given it's already at 309 and, like we were saying, a $1.25 trillion market cap?
So I think one of our colleagues, Jaron, on our stocks team, kind of wrote actually a really good story last week, which addresses that, which is that Apple in the last maybe 10 years has kind of been seen as a hardware company, a really, really good hardware company. But when you're a hardware company, you have lower margins, or your revenue is a bit more up and down. And now when it's adding a lot of these services to the hardware business, that's a lot of recurring revenue, new subscriptions and things like that from Apple Music, and that type of revenue is steadier, and investors like to give that a higher P ratio. So I think some of the gains are investors are just re-rating this company and giving it a higher valuation.
Well, great analysis on all things Apple and that 309, $1.25 trillion market cap. That is Bloomberg's Alistair Barr. Thank you for joining us. Now, another company we're looking at, it's WeWork, hitting the brakes. New leases by the office sharing firm took a dive in two biggest markets in the fourth quarter. WeWork signed the lowest amount of space in Manhattan in more than 5 years. New space in London also grew the least since the Brexit vote in 2016. All of this comes as WeWork scrapped plans for an IPO and needed to be rescued by SoftBank. So for more, I want to bring in Bloomberg Technology's Ellen Hewitt, who has been covering the company. What do we know, Ellen, about the size and scope of the slowdown?
We know it's pretty significant. These are major drops in the amount of new leases that the company is signing. This shows that basically, as early as September, the company was really putting the brakes on signing new leases for this last quarter of the year, which is a huge change from how the company had been growing at a huge and very fast rate for the last couple years before that. This was something that they had been actually pushing forward much more than usual in the months leading up to what they expected would be an IPO in September. But now that that is off the table for the time being, it seems like new leases are off, and we'll probably see continued slowdown in growth for the company going forward.
Ellen, is the slowdown appropriate given the company's in the middle of, frankly, trying to right-size itself?
Yeah, it seems on path with what they have said is important to them. And I'm sure some more cautious investors are looking at this and thinking, this is probably prudent. This is the company getting back on track and growing in a way that maybe might make more sense for the type of business they're in, which does require signing these very long leases, sometimes 10 to 15 years. That being said, the company still says that they opened a record number of offices in December. I think that's just a continuation of a pattern of signing leases earlier in the year and continuing construction. And so we're going to continue to see new offices opening because those take many months to get ready and to get online. So those are still remnants of the ultra growth period of earlier 2019. But we expect to see fewer of those going forward because the company, as you said, has made public pledges to slow down this aggressive growth and try to get to profitability.
Ellen, I want to show you a chart that I'm showing inside my terminal. You know this story better than anyone. The bond prices, at least, have appeared to stabilize. They're at 80 cents on the dollar, way off the lows that we saw in November at 70 cents a dollar. We fold the market bond yield price stabilization into your world of the company. Is the company appearing as stable internally as at least the market appears to think they are?
I think there are still question marks around where the company is going to go in the next 6 months. They have a huge apparent leadership gap, right? So they had these two co-CEOs step in as soon as Adam Neumann stepped down in September. But they continued to have rumors of looking for new CEOs or doing another CEO search. So I'm sure internally people are thinking that these replacement CEOs are maybe not long for the position. Meanwhile, they have a new executive leader in the form of their executive chairman who was installed from SoftBank. This is a new person who's also kind of running the show, but also not CEO. I think people feel probably pretty shaken up as well. Employees went through very serious layoffs in the last couple months, huge cuts at the company. So people probably feel their future is a little uncertain. The company seems more stable than it did during the very rocky times of September and October, but the future is probably still a little unsure.
Bloomberg's Ellen Hewitt, thank you for joining. And coming up, that food delivery business is getting crowded, and Grubhub may be looking to consolidate. We'll discuss next. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg app, Bloomberg.com, and in the U.S. on Sirius XM. This is Bloomberg. Wall Street is weighing reports that Grubhub is exploring strategic options in the midst of intense competition and steep discounts. The news gives fresh impetus to the idea that food delivery companies have no choice but to merge or acquire. To discuss, we're joined by D.A. Davidson analyst Tom White, and also with us, Jefferies analyst Brent Thill. Brent, you've been covering Grubhub, so let me start with you. Get your thoughts on Grubhub being bought or Grubhub buying someone else.
I think, there's both are logical outcome. You've seen, consolidation in the space with DoorDash buying Caviar. You're seeing, other smaller regional players get rolled up by others in the industry. So I think it could go either way. Clearly, there's been a lot of pressure on the revenue and the margin as both Uber and DoorDash have come in and put a lot of focus on this market. So, our short-term thesis is that Grub is dislocated from this, given they had really great growth and great margins. But long-term, I think that the economics can be restored. I think the CEO of Grubhub has said that consumers should not get used to the prices that they're seeing right now because they're not sustainable. And so I think, like in any market, you see too many vendors chase the market, and you're seeing that now. There's just way too much competition that will consolidate and potentially economics restore. So I think you could see, there's a standalone case for Grub where they could actually do very well among, three big players, which we think they would be the third biggest. And there's another case where you could see, would Amazon want to acquire this? Could Uber or DoorDash look at a way to consolidate some of the assets together? Could another large food company or beverage company look at this? I think there are a lot of options where shareholders could win at this level. We don't have a buy in the stock, but do believe that you could see a higher price.
Well, Brent, you mentioned Uber Eats. So, Tom, let me come and pose this question to you. As you've been covering Uber and Uber Eats, do you see potential for Uber Eats to come in here and take up Grub?
Yeah, I think I do. I mean, echoing the comments of my colleague here, I think this is a space that is ripe for consolidation. You've got a lot of businesses that have very similar, if not identical, business models. They're burning cash, chasing growth. And so on paper, consolidation just seems to make a lot of sense here. I do think for Uber, it makes a ton of strategic sense to potentially explore this. I think there's reasonable questions as to whether or not they could get a deal done. I think Uber's got a bit of a target on their back, if you will, in the eyes of regulators kind of broadly. So that's an open question. I mean, ultimately, with these sorts of deals, when antitrust folks look at it, it kind of depends on how they define the market. Are they going to define it narrowly as just online food delivery? Or are they going to sort of look more broadly at food delivery in general, including offline, or just sort of restaurant volume overall? I think so. There's some questions there, but also to Brett's point, I think one thing that also could go against this deal or a deal happening a little bit is just that it will likely result in prices for consumers going up, and that's not something that regulators generally like to see when they're going to approve some sort of large-scale merger. I mean, I think it's inevitable eventually that that's going to happen, but a deal would probably accelerate that timeline.
Brent, your thoughts on a potential valuation of Grub? A lot of our analysis has shown you're looking at maybe 5 to 6 times EV to sales, similar to a deal when you had takeaways pending purchase of Just Eat. Do you agree with that valuation?
Yeah, I mean, I think that's right. When you look at, the street has a massive deceleration in growth this year. So the one thing you could argue is the street looking too far in terms of deceleration in Grub's growth rate, given the investments they're making in these new markets. So if they can actually show a little bit better growth, I mean, you're looking at a multiple that's 3 times 3.5 times forward sales, which is not a big multiple, and that's below that of Just Eat. And then if you look at other industry leaders, you've seen multiples that are fetching, 5 to 6, 7 times forward. We deal with a lot of software companies that have sold for 15 times revenue. So I think the right range for tech M&A is somewhere, if you're a really struggling asset, it could be 3 to 4 times, but you're seeing assets trading, between 5 and high single digits. So I think you can get to a higher multiple, assuming the revenue doesn't implode. You can get a higher stock price, both organically and inorganically, if they execute a little bit better than they have in the last year. But there are obviously a bunch of what ifs. But the multiple at Just Eat will get you a higher stock than where it is today.
So, Tom, talk to me a little bit about that organic versus inorganic growth, because Dara Khosrowshahi said Uber Eats would be better served growing organically. But can they get there? Because this is an economies of scale business that's frankly very capital intensive as well.
Yeah, look, I think optimally you'd be able to grow organically, but if you recall, Uber's also put out a very aggressive timeline for achieving profitability, and I think consolidation in online food delivery of meaningful kind of scale would sort of help accelerate that timeline. I just wanted to touch on the idea of valuation here, because while I think that it's obviously appropriate to sort of analyze the multiples, in deals like this where you've got a strategic asset that is somewhat scarce, that is a large online food delivery network, a fully scaled and profitable one that has a lot of potential suitors looking at it, this could be one of those situations where the ultimate winner is basically the guy who's just willing to pay what it takes to kind of keep it out of the hands of what they view as their kind of more serious kind of long-term competitor. So, I think we could see a wide range of outcomes on valuation here.
Okay, well, that was Tom White of D.A. Davidson. Thank you for joining us. And Brent Thill, you're sticking with us, because coming up next, we're going to discuss how Jefferies sees more room to run after Snap's 2019 rally. Snap shares jumping off his note. This is Bloomberg. Snap shares spiked Thursday after the social media company received 2 upgrades, with both firms citing an improved view towards its 2020 prospects. Cowen boosted its price target to $20 from $16. The move comes on the heels of Jefferies lifting its rating to a buy from a hold in a note published after the market closed on January 8th. Jefferies analyst Brent Thill raised his own target to $21 from $17. And Brent joins us now. Brent, come and take a look at a chart here that I'm showing inside my terminal. Really, analysts have struggled to sort of stay ahead of the big rally in Snap shares. Your take on the path from 17 to 21?
Yeah, I mean, look, last year was a huge move. I mean, the stock was one of the best performing names, and I think the stock was oversold, and they fundamentally put the company back on track with the rebuild of the Android version. They've got the financials under control. There were a lot of things they got set up, and so we missed part of that run. We don't get them all right, and I think our view going forward is that, does it still have more room? And the answer is yes. Clearly, getting to the low 20s isn't as big as a move as it had from a single-digit stock ending the following year in the past year to what happened last year. So our view is that it's still a good story that's showing improvement in monetization, showing improvement in terms of users coming to the platform. And then lastly, financially, they're actually showing bottom line support by getting towards profitability at the end of the year. And so we think all these things are moving in the right direction, and that's why we don't expect the stock to double from here, but we still have enough room for a buy to get over 15% upside from current levels. We would highlight that Facebook's still our number 1 pick in social. We still see a pathway to $250 a share for Facebook. So Facebook a favorite, Snap would be number 2.
So stick with me on Snap for a little bit. One thing that caught my eye in your note is you highlighted accelerating international growth. I was looking through some of the research, and while domestic users are only about 40% of revenue, they're 60% of profits. If the domestic user appears to be more profitable, why the attention on the international user growth?
Well, I think clearly it's a global platform. There's an opportunity to get a lot more users to this. Obviously, those users are not as profitable as they are in the U.S., and you're seeing that at other social companies that we cover as well. So I think their goal is to get into the hands as many of the users as they can. Obviously, they're selling advertising, and the broader base gives an advertiser a bigger chunk at trying to reach that audience. And the way I look at this is that, I have kids on the platform, so I ask my own kids what they use. And today they use it mainly for communication. But they literally spend half their time on the map, and the map tells them where their friends are. And so if you're a restaurant or a retailer and you want to offer something to those individuals, they know where you're at on the map, and they can throw an offer up over time. These are things that they have not baked in. So the international opportunity follows the same pathway I think that other social media companies have done. Get users on the platform. They're lower ASP and clearly higher dollars to serve right now, but over time that changes. And then there's a ton of different ways they can monetize them through video games, through content, through the map, which I'm most excited when I talk to teens, when we interview teens about what they like about it. There's a big opportunity. Even Evan, the founder at Snap, has said there's a tremendous opportunity on the map over time. So again, I think there's a lot of different drivers in place, and we have a very healthy ad market that's in place right now, as evidenced by what you're seeing with Google, Facebook, a number of the companies we cover.
Brent, you mentioned Facebook earlier, and I wonder where does Snap fit in within that social media space relative to, frankly, bigger companies like a Facebook. Where is Snap's sweet spot in terms of gaining a little bit of the share of those advertising dollars?
It's a younger audience. It's the mid-teens to into the mid.
This is Bloomberg Technology Global Link, where we join Bloomberg Daybreak Australia to bring you the latest in global tech news. I'm Taylor Riggs in San Francisco with Sophie Cameron in Hong Kong and Heidi Stroud-Watts in Sydney. Let's take a look at those top global tech stories of the day. Sophie.
Now, Taylor, Apple CEO Tim Cook will receive an award in Dublin later this month to mark the iPhone maker's 40 years of investment in Ireland. But the decision may raise some eyebrows. The company is still reeling from being hit with a record 13 billion euro tax bill from the European Commission in one of the biggest state aid cases on record. Venture capital company Insight Partners has agreed to buy Swiss cloud firm VM, which is now valued at $5 billion. The deal will allow the cloud data management company to expand into new geographies. Founded in 2006, VM simplifies backups for virtual machines. It also helps customers manage, monitor, and run analytics or software and data in the cloud. Alibaba and Tencent are ranked as China's second and third best environmental citizens in research by Greenpeace. The report ranks 15 of China's biggest tech firms and calls attention to the sector's ballooning energy consumption. The winner, Chin Data, is a little-known unicorn in waiting, backed by Bain Capital. Greenpeace says the majority lack in public disclosure and progress in moving to renewable energy sources. And those are the top global tech stories we're watching. Heidi?
Sophie, well, as the Taiwanese election nears, the country's Foreign Minister Joseph Wu says China has become more tech-savvy in its alleged interference of the election.
Beginning from last year, we saw that China is using modern technology. In short, it's the social media platforms to try to interrupt in our discussions on the internet. Either through Facebook or Twitter, or even a popular online chat mechanism. It's called Line. The fake news situation seems to be quite serious.
All right, let's discuss more on China's disinformation campaign. I want to bring in our very own Bloomberg Stephen Engel, who is live in Taipei today. He spoke with the Taiwanese foreign minister. Steve, what are we seeing?
Yeah, well, we are seeing, at least from the DPP, which is the incumbent ruling party here, that there's been increased interference by China in this election to kind of sow divisions in society and also to kind of control the narrative here, because there are divisive camps here between the KMT and the DPP. Different visions for the future of Hong Kong. One is more, pro, I won't say independence, but more pro status quo. The other one's the KMT, longtime ruling party, but now on the outside trying to get back into the presidential office back here behind me. They want more economic integration with China. But this information warfare, if you will, it's interesting because the Lowy Institute says Taiwan has the highest rate, among the highest rates of cyber attacks in the world. And get a load of this figure. The National Security Bureau reports approximately 30 million cyber attacks a month hit Taiwan. 30 million. That's about a million a day. And the National Bureau also is saying here that 60% of those attacks are coming from China.
Stephen, what is big tech in China, in Taiwan, doing about the increased misinformation?
Well, it's an interesting topic, obviously, because fake news is an issue anywhere in the world, if you want to use that term. What's really interesting about the economy right now is how it's kind of really also taken over the narrative here. Is bigger and better integration with China economically a plus? Well, if you look at the latest numbers, actually, the Taiwanese economy is doing really well with the opposition, if you will, to China candidate in the presidential office, Tsai Ing-wen. The Taiwanese economy is expected to grow last year at 2.5%, upwards closer to 3% in 2020 because of the U.S.-China trade war has actually benefited Taiwan. More manufacturers in the tech supply chain have actually onshored. They have come back to Taiwan. That has boosted the economy. There's been lots of foreign investment as well. And then there's the uptick in the chip cycle, which is obviously benefiting the likes of Taiwan Semiconductor and the other big fabs here in Taiwan. So Hong Kong is a big issue in this election. China is, but the economy playing a central role as well.
Yeah, Steve, we're just getting some lines crossing the Bloomberg with Mike Pompeo saying that he's set to meet tech companies in Japan and South Korea, those counterparts next week, taking place in California from January 12th to the 15th. Of course, that also comes before that Phase 1 trade deal is expected to be signed with China on January 15th. In terms of the element of tech that we're talking about, we've also seen, the spreading of disinformation, if you will, in the Hong Kong protests. I'm wondering in the Taiwan elections, how much of an impact watching what's been going on in Hong Kong is going to play in the way that the campaigns are taking place and also how voters are thinking at the moment?
Well, even the Foreign Minister, Joseph Wu, conceded when I asked him these questions. He said, yes, the Taiwan issue has played a role in the psyche here of the voters because Taiwan promotes democracy. And even the challenging candidate, Han Kuo-yu of the KMT, which wants more economic integration with mainland China, he's even told Bloomberg in an interview in November, I believe it was, that he supports democracy for Hong Kong. However, as long as it comes with a call or at least a law prohibiting prohibiting independence from China. So absolutely many, about 80 to 90%, according to some polls of Taiwanese, they identify as Taiwanese, not necessarily Chinese. So that's a critical role. As you can see, people obviously take their democracy and their elections quite seriously here in Taiwan.
Bloomberg's Stephen Ingle, thank you for joining us, and much more ahead, so stick with us. This is Bloomberg. One more reason for Elon Musk to dance. The Tesla CEO was booking earlier this week when production formally began at his new factory in China. On Wednesday, shares of the electric car maker rose more than 4% to another record. Tesla's market cap is now more than $88 billion. That's more than Ford and GM combined. If it hits $100 billion, the first tranche of Musk's all-or-nothing pay package would be unlocked. That would net him about $346 million. Now, popular viral video app TikTok may have outlined new rules to crack down on misinformation, but it still has a big problem when it comes to politicians. Unlike Facebook and Twitter, the viral video app doesn't have a robust identity verification system to certify accounts. And that's led to multiple accounts impersonating the likes of President Donald Trump and Indian Prime Minister Narendra Modi. Some of those accounts have thousands of followers. Joining us to discuss from New York, it is Bloomberg's Yuqi Young. Great to have you here. What kind of accounts that were being impersonated did you discover in your reporting?
So on TikTok, we found many accounts that are claiming to be public figures and important politicians such as Donald Trump, Boris Johnson, and the team of Bernie Sanders. And some of these accounts are parody accounts, and it's apparent, but the rest of them look actually pretty real. They take the real profile photo of Donald Trump, for example, and that has apparently misled some users to believe that that account belongs to Donald Trump. And users left comments such as, "Mr. Trump, welcome to TikTok. We're also here new."
Why are there so many impersonating accounts?
So one big reason is that these politicians are currently not on TikTok, so there's no verified accounts with a blue check mark that can tell users that those are the real ones and the rest of them are the fake ones. And another issue is that TikTok, like many of the other social media platforms, are not actively combing through all the accounts. They only take down the impersonator accounts when those are being flagged to the company.
Yeah, and beyond that, what is TikTok in your reporting telling you about what they're doing to help resolve these major security issues?
So TikTok is ramping up their team working on content safety and verification in California. They're hiring people from other social media platforms like Facebook and Twitter who have been working on the similar issues before. And the company released a new guideline this week, expanding their policy on content verification and fixing some of the loopholes they had before.
Well, and this frankly plays right into the hands of U.S. politicians who have TikTok under CFIUS review. We know that TikTok, of course, is owned by ByteDance. They're claiming that a lot of this is around national security issues. What are some of those threats that they see within national security?
Yes, so U.S. politicians has expressed concerns about the safety of the data of TikTok, and they are also worried about potential censorship, and they're worried about foreign influence from other governments, especially the Chinese governments. And TikTok has said that all the data for U.S. users is stored in the U.S. with backup in Singapore, so they're beyond the reach of the Chinese government. And TikTok also denied any censorship or any influence from foreign governments.
Yeah, Bloomberg's Yuqi Young, thank you for joining us.
Thank you.
And now turning to our coverage of CES Las Vegas, China-backed EV startup Byton announced a partnership with Viacom CBS to stream video content directly to the 48-inch screen in their cars. The M-Byte doesn't go into production until later this year, but the company's CEO is already thinking about making money from data going in and out of the EV. Daniel Kirchert spoke to Bloomberg's Ed Ludlow at CES.
We have founded Byton with the vision of building a smart device on wheels, yeah? And obviously, I think our role of the car will clearly change in the future, and I think it will become kind of a fourth space. I mean, right now, time in cars is downtime, right? We go from A to B, it's a waste of time. But with the technology we are bringing in, making the car a smart device, it will also become a digital living space. Huh? We will be able to work, we will be able to entertain, and bring in content to the car to stream is the next logical step. And of course, in a normal driving scenario, you won't distract the drivers putting a movie there.
Right.
But you might want to charge your electric car somewhere and watch something great.
Right.
Or you're in the rear seat, or you even think the experience on our 48-inch display is so great. It's such a big screen that you just want to be there with your friends.
So what is the customer getting from Viacom CBS? It's basically video content straight into the car.
I mean, the Viacom CBS, including Paramount Pictures portfolio is huge. Huh? I mean, the whole amount of content, and I mean, they're having the Olympic rights, for example, in 2020. So we will and they're a global player, truly global player. So, and we are launching global. So we will custom tailor-make content package for our users. And of course, we have this face recognition in the car, which really identifies the individual users. So we can make tailor-made packages based on individual customer profiles, and that's what we're going to do. We are going to jointly work with them now on providing, until we launch, the perfect content for every
So what's
market.
the revenue split? How does that agreement work with Viacom CBS?
Of course, there's a revenue sharing for these kind of things, yeah. And that's of course also a future revenue stream for us. Besides selling a great car, we have built a great digital platform, which is a device where we bring in great content, and the users will be willing to pay for great content. And of course, we're going to share that with parties.
So how do you see the revenue split in the future? Because others are talking about this. You get revenue from the sale of the car, the leasing of the car.
Yeah.
But how do you see the contribution of data, monetizing that data?
Without any doubt, that will become a major source of revenue in the mobility industry, let's call it like that.
Yeah.
Being on the move and being connected on the move and monetizing data streams from there. If you ask me, do I have a perfect idea in 2 years or in 3 years how much that's going to be? I would say no. But the first step is to clearly generate this kind of wow effect for users.
Right.
Yeah? I mean, a kind of lock-in effect. They're going to use something in the car or getting an experience in the car which in a traditional car they would never been able to get. Yeah? If you get this lock-in effect, you're going to go there and you're going to stay there, and you will be willing at a certain point of time to also be charged for that if it really provides you with additional value. But initially, we're not over-focusing on the revenue generation. We are more focusing on this wow effect.
Talk to me about the M-Byte. I've been in the M-Byte. It has a large console that kind of spans the dash of the car. I know that there's some advanced telematics in the car. It has a cellular connection, of course, which one day should carry a 5G connection. You've looked at bringing some health data into the car, connecting it to health apps. Could we see biometrics go in? What other kind of items will we see in the M-Byte?
Absolutely, you're right. I mean, we designed the car from inside out, right? With this great 48-inch display, which gives you a great experience. There's a touchpad in the steering wheel. That's also the world's first. So it's a completely new user interface. Yeah? And we're going to bring in things like health, things like office, things like entertainment. And for the health side, we definitely believe there's a demand for people to know about that and connect their health data from the other devices. Just giving a simple example, I mean, the smart car could tell you that you are 15 minutes early for your meeting and ask you if you want to park maybe 2 miles away and take a walk, in order to come up with your personal health target or make sure that you reach your 10,000 steps per day. And that's pretty meaningful.
That was Byton CEO Daniel Kirchart speaking to our own Ed Ludlow at CES in Las Vegas. And still ahead, the battle of the cloud wars are heating up as Microsoft continues to try to gain market share from Amazon's AWS. More on their targeted retail strategy next. This is Bloomberg.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
It's no news that Microsoft competes with Amazon in the cloud, but a new target seems to be its retail customers. For details, I want to bring in Bloomberg's Dina Bass and Mizuho analyst Greg Moskowitz. Dina, let me just start with you. What do we know about Microsoft's retail strategy to further take on Amazon?
Sure. So we're talking about this, first of all, because Microsoft CEO Satya Nadella is keynoting a big retail show on Sunday. And The reason for this is retail's just one of their most important sectors. Generally speaking, Amazon Web Services dominates the market, but none of those retailers want to work with Amazon, which is one of their biggest competitors in Amazon's consumer business. They don't want to line Amazon's pockets with cloud revenue. So Microsoft has been working with a lot of these customers, from Kroger to Walgreens to now IKEA, on a bunch of different things like store of the future kind of concepts, ways to help these companies' e-commerce sites better monetize, sell more advertising, things that will help these retailers do a better job of competing with Amazon's consumer business. And at the same token, these relationships help Microsoft's cloud business compete better with Amazon's cloud business.
Greg, as you take a look at Microsoft in your coverage, where do you see them being able to expand some of their cloud offerings to really go more toe-to-toe with Amazon?
Sure, and I would say maybe first of all, just to take a step back, Amazon has built a terrific service. It's going to get a lot larger over time. However, we have fairly consistently seen Microsoft narrow the gap in terms of size vis-a-vis AWS, and we expect that's going to continue. They're doing a better job disproportionately getting more enterprise business. They recently won a $10 billion contract with the DoD over a 10-year period that we think is going to open a lot of doors for them. And then, as Dina mentioned, you have the retail aspect, and I would say it really was last year in 2019 when we first began to hear about Microsoft pitching to customers that they are the more logical presence or cloud provider as it relates to those retail companies, where again they're not sort of in the crosshair, so to speak, as that might be the case with AWS. So those would be again areas where we're seeing Microsoft gain momentum.
Yeah, Greg, just to follow up, because you mentioned that DoD contract, as you take a look at that JEDI contract and some other public cloud contracts that become available, is that really a key area of growth for Microsoft?
We think it is. This unquestionably validates, if this was not the case already, that Microsoft's Azure is an enterprise-grade solution. This is a contract where Microsoft is the sole software provider, and again, this is the DoD making a $10 billion commitment over a 10-year period. And so it's hard to get a much better testament than that. We do think this is going to serve as a foray into some more government deals, by the way, not just within U.S. Federal agencies, but also international governments. In addition, we think it can be a facilitator for some very large enterprise deals, which they don't currently have, because again, it's hard to get much bigger than the DoD in terms of scale.
Mm-hmm. Dina, some of your reporting was talking about a revamp of the Microsoft Teams to more directly take on Slack. What do we know about those two as they seem to go toe-to-toe?
Sure, and so this is a different part of Microsoft's cloud business. This is the part where, unlike in the part where they compete with Amazon, they're actually the incumbent and the larger vendor here, which is their Office cloud. But the portion of that where they have not been the leader or the pioneer is the enterprise chat market, where Slack created the market and Microsoft's been responding. So, what Microsoft has done to catch up, first of all, is a more standard strategy for Microsoft of putting Slack, their Teams product in the Office cloud product for free. But the other thing they're doing is trying to leverage the strength they have in different enterprise verticals. So we talked before about retail. They're also looking at banking and healthcare and figuring out what features those sorts of employees need. And so today they announced a feature for retailers, for store employees, where you can press a button on your Teams chat in order to turn your personal mobile phone into a walkie-talkie. And the idea is that would allow store employees to talk to each other. They're looking at similar features like that in manufacturing and finance and in a couple of other industries where Microsoft has historically been strong with their cloud products as a way to kind of derail Slack and grow faster.
And Greg, as you take a look at the Microsoft Teams business, is Slack real competition?
Slack, in our view, still has a best-in-class product, and as Dina said, they have created a category. However, what we have seen is that Microsoft has made significant functional improvements to Microsoft Teams over the course of the past year. In addition, we are very confident in saying that they are not going to let up. We expect them to invest very substantially in Teams. It is an incredibly strategic product for Microsoft. We wrote a research report a few months ago, and we said that other than than Azure, Microsoft Teams is arguably the most strategic product that Microsoft has introduced in the last decade. Given Microsoft's breadth, that's obviously a very big statement.
And Greg, just about 30 seconds here or so, Cowen had upgraded Microsoft based on an overlooked ad business. Where do you feel like their ad business is in relation to Microsoft as a whole?
So, Microsoft's ad business is relatively small, frankly, as a piece of the pie. This is a company that is going to do over $150 billion, according to our estimates, in fiscal 21. So, advertising is relatively small, but it has been a consistent double-digit grower, and they've done a nice job executing versus where things were a few years ago.
Bloomberg's Dina Bass and Greg Moskowitz of Mizuho Americas, thank you both for joining. And that does it for this edition of Bloomberg Technology. Bloomberg Technology is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network at Quick Take on Twitter. This is Bloomberg.